Since the start of the year, tech stocks have gone crazy. All companies in the Magnificent Seven carrying the US stock market. Microsoft up 54% since the start of the year, driven by great performance and their investments in AI technology taking great leaps forward. Apple and Google stock both up 51%. Amazon stock up 69% with AWS running the show, and with their advertising business showing great resilience. Not a big tech company, but still part of the Magnificent Seven. Tesla, Elon Musk's car company, up a massive 116% this year. And even better still, Meta, with their disastrous PR campaign changing to the metaverse. Meta, otherwise known as Facebook, has completely turned their stock price around, being up a massive 168%. And finally, Nvidia, stealing the show with a massive 244% gain this year. Can we expect more gains this year, or have we missed the boat? Well, in this video, I'm going to talk about how actually they might not be overpriced, and there might still be more room for growth, or whether it's time to hold or sell out of these stocks. So if we take a look at the S&P 500's performance since January, we can see that it is up a massive 18% this year. And there's been a lot of talk about this, primarily because of the Magnificent Seven, and the fact that these 7 companies make up the majority of the gains that we've seen in the market. If we take a look at the equal weighting index for the S&P 500, meaning that all companies in the S&P 500 are given an equal weighting, we can see that it's been pretty flat this year, being up only about 3%, with a lot of this recovery happening in the last couple of weeks. So we can see that the US market has been pretty flat if you take out the massive impact that the Magnificent Seven has had over the last 12 months. But we still need to answer the question, can we still buy big tech after they've had such a good run? Dan Ives, a well-known and popular analyst on Wall Street, still thinks that big tech is cheap. Let's take a look at this clip of him from a few days ago on CNBC.
To me, it's all about use cases. I mean, we right now have about 80 use cases for AI based on all of our survey work. 3 months ago, that was 15 to 20. And I think that's what we're seeing even in earnings. If you look at Palantir, you look at Microsoft, you look at Datadog, now it's the first, second derivative, and we believe the third and fourth are going to hit in 2024, which is why, in my opinion, the new tech bull market has begun.
He thinks that this is just a recovery and we are still set for another run due to the impact that AI has had on all of these companies.
And I think that's the key from an install-based perspective. You look at Adobe, you look at names like Oracle, you look at Salesforce, and of course right now at the top of the mountain is, of course, Microsoft, but you look at what AWS is doing, that's a huge monetization opportunity for them. And I believe right now that's the golden goose. That's what this is going after. And we think it's $1 trillion of spend over the next decade. It's going to hit the shores of tech.
Now, it's hard to say that he is completely wrong here. Big tech altogether have their world at their fingertips, and they're going to use that, fueled by AI, to make massive profits over the coming years. And he says that a lot of bears, people who think pessimistically on the markets, aren't in big tech right now, and them coming back into the market could push their stock prices even higher.
The next wave is going to be broader tech in terms of small, mid-cap. And I think right now, a lot of bears, they're coming out of hibernation mode. And I believe they go back in terms of what I view as just a tech that ultimately could be up 8 to 10% more going into year end. And now it's not just hype. You're actually starting to see the use cases explode. And that's why it all starts with NVIDIA, then it goes to Microsoft and all the hyperscale players. And that's why, to me, it's not just to call it 5, 7 players. I think as we look out, you're going to have 15, 20, 25 players across software and chips participate.
So Dan Ives and a lot of other big investors are very excited about big tech, and they'll be jumping back into the market and chasing the gains. So if we take a look at Microsoft, we can see here that their price to earnings ratio is sitting at 35.8. And this graph shows the trend that it's been on since January 2023. In January, it was at about a 26 PE ratio. And if we take a look again at the stock price since January, we can see that these two graphs are quite similar, almost identical in the trend. Then if we take a look at the same thing for Apple, we can see here the price to earnings ratio is 31. In January, it was around 25. And if we take a look at the stock price graph, we can see again that it's very similar. This shows that the stock price has gone up, driving up the price to earnings ratio. And although earnings would have had some effect on the stock price, the main driver for the PE ratio going up is the stock price itself. This goes to show how low the stock price was in January or even November 1 year ago. And it gives an indication that the stock price could be considered quite high right now. But if we take a look at the PE ratio again, but this time going back 5 years, we can see how high the price to earnings ratio was during the pandemic, and it peaked at over 40. And this shows that the stock price could potentially go higher if we see another period of hype with all the people that missed out this year joining in at the end of this year and at the start of next year. And this is the same for all of the Magnificent Seven over the past year, with the exception of Amazon, with their strange financial results over the past few years, and Nvidia, who has performed amazingly well recently. But this is to say that investor sentiment is really driving the stock market performance right now. The only company that has a relatively low PE ratio now is Google, sitting at around 26, although the stock price has gained about 50% this year. Now I'd like to show you the performance of my holdings in these companies. I hold Microsoft, Google, Apple, and Amazon, so 4 of the Magnificent 7. I purchased my first holdings in Microsoft, Google, and Amazon in October and November last year. This was 50% luck, as I'd recently sold out of a big position in an ETF last year, and 50% was skill because I'd seen that the stock prices were very low at that point, and it was clear to me that they were very cheap, although I didn't exactly know that I'd bought at the bottom of the market. So taking a look at Microsoft, I have about $1,500 in this holding right now, from just about $940 invested, and that means I've got $560 in gains, which means it is about a 60% gain. And looking at the transactions, you can see that I've made 4 buys in September, October, and November last year, and I haven't sold any since then. It's the second biggest position in my portfolio at the moment, sitting at around £1,200. I also bought Google at the same time, with my holdings sitting at $1,062, which is about $730 invested and $330 of gains, which is a 46% gain. And again, looking at the transactions, it's almost identical to the ones I made in Microsoft. I bought in September, October, and November last year, and haven't made any more purchases or sales since then. The next one is Apple, and Apple is a recent addition to the portfolio. I bought Apple because of recent performance, and I think Apple will continue to perform in terms of their earnings and their growth potential across the globe. This position is up 8.7%, and if we take a look at the transactions, I only bought a few shares starting in September 2023. The holding is sitting at about $600 with a gain of $50. And my final position in Amazon, which is up just about 60%. This is one of my smaller positions, and I just made 1 buy of 3.8 shares at a price of $89 a share in November last year. So those are my holdings, and you can see that I've done quite well this year from those holdings. And maybe I'll think about trimming the position slightly if the prices go higher. But we should listen to legendary investor Peter Lynch when he said that selling your winners and holding your losers is like cutting the flowers and watering the weeds. And what we can take from that is that you shouldn't just sell a stock because the price is high. You should consider more factors before making any decisions on a hold or a buy or a sell. But I believe I won't be adding more to any of these positions until the valuations come down. And I'll be accumulating cash until I find other companies that are cheap and have good valuations. Let me know what you think in the comments. Is big tech overpriced, or are the analysts right? Is there still more room for growth this year? Subscribe, leave a like on the video, and thank you for watching. Well, you'll notice that my head is shaved. I haven't got any hair, but the other videos I had hair. I'm actually raising money for Movember, which is a mental health, which is a charity that raises money for mental health, prostate cancer, testicular cancer, and there's a lot of things in terms of men's health across the world. I potentially have footage of my head being shaved, which would be nice. I think I might pop some of that up on the screen now. Pop some of that up on the screen now. And you can see that, well, I need to shave my beard, but I do have a moustache. So there's going to be a link in the description for to be able to donate if you feel like that, if you feel like you want to donate. My goal is to raise £1,000, and hopefully I'll be hitting that by the end of the month. I've been doing this for a few years now. I usually grow a moustache. I've done that 2 years in a row, but this year I decided to shave my head. But you can see it's grown back quite a bit already. As it is, we're about 2 weeks into the month. So yeah, thank you for getting this far into the video and listening to that.